Hello friends, welcome to the lesson on ratio analysis. This topic is very much important for RBI Grade B examination under finance and management section. Actually, the basis for financial analysis, planning and decision making on a company is financial statement, which mainly consists of balance sheet and profit and loss account. So from the profit and loss account, it shows the operating activities of the company for a particular period of time. For example, let's say 12 months of duration. And the balance sheet, whereas the balance sheet shows the balance value of acquired assets and liabilities at a particular point of time at the end of the year as in 31st March. So why we need to do financial analysis and financial statements? For example, whenever a company approaches a bank for giving for loan, the bank will ask for financial analysis. The bank will do financial analysis and will come to a conclusion that this company is having credit worthiness and lending to this company will not become a non-performing asset in the future course of time. So how bank decides? By doing financial analysis. So you must know what are the financial analysis and analytical tools available for doing financial analysis. So I just mentioned that this topic is very much important to analyze the credit worthiness and know the future potential of the particular company. So, and we have seen that the profit and loss account and what are the information we can get from the profit and loss account and the balance sheet. However, there is a drawback here. The balance sheet and profit and loss account do not disclose all necessary and relevant information. For ascertaining the financial strength and weakness of a company, an effort of analyzing the individual accounting figures and making sense of it is inevitable. So to analyze the data, we have analytical tools. So what are these analytical tools? Which would help in financial analysis and planning. So there are two types of analytical tools. One is the ratio and cash flow analysis. First we'll discuss here ratio analysis and then we'll move on to cash flow. So it is necessary to know the meaning of terms ratio and ratio analysis before we move further. Here ratio means the financial ratio, which is a mathematical expression of the relationship between accounting figures. For example, earning per share is one such example. It shows the relationship between profit and equity shares. For example, what do you understand by the term earning per share? So it literally means how much profit earned by individual equity share holder. For example, if a company is getting 10 lakhs of profit and it is having 10 lakhs of share, so each individual shareholder will has in 1 rupee as profit or earning. So it shows the relationship between profit and equity shares. So without doing ratio analysis, you will not come to know the relationship between equity and profit. So the ratio analysis is based on the fact that a single accounting figure, that is equity shares here, by itself may not communicate meaningful information, but when expressed as a relative to some other figure. In the example, we have seen that equity shares relative to profit. So it gave a mathematical expression of earning per share, and which is quantifiable. So it may definitely provide some significant information. So here earning per share, we have seen the example of earning per share. So we have taken profits in the numerator and the equity shares in the denominator. So we came to know that earning per share is of this much. So this way the ratio analysis help to decide or to make to bring conclusion about the relationship between two accounting figures. So by ratio analysis, one can draw conclusions about the performance, past, present and future. For example, if you take Infosys company and if you look at the financial statement, earning per share is of, let's say it's having 1000 per share. So just by looking at the earning per share, we can say that okay, this company is performing well. So just that's it. That is the reason I have taken Infosys as an example. So Infosys is performing well by just looking at earning per share, because its growth potential is increasing time and again. And we'll come to know the strength and weakness of a firm. For example, if earning per share is negative, then bank will not lend or will not give credit to that particular company. The reason being, when earning per share is negative, so how can company able to pay interest to the particular bank? So this is the weakness of a firm. And what's the strength? When earning per share is high, so there is a high potential for this company to grow further and pay off the debt whenever it is in due. So there is no reason why this company may go into crisis. And the bank or the company can take the informed decisions about the firm, about the expansion, or um, going into another line of business likewise, and comparison with other companies industry for knowing its a growth potential. So these are the conclusions one can draw from the ratio analysis. So what are the types of ratios available here? There are four types, and there are sub ratios as well. Now, one is the liquidity ratio, which is also termed as short-term insolvency ratio, and the second one is leverage ratio, which is also termed as long-term solvency ratio. These are subdivided into capital structure ratio and coverage ratio. And third one is activity ratio, efficiency or performance ratios. Fourth one is the profitability ratio, which is subcategorized as three parts. One is related to sales, related to overall return on investment, and related to market valuation. So I guess these are the four types of ratio we need to study in-depth manner. In the upcoming lessons, I'm going to deal these kind of ratios one by one. So thank you for watching this lesson. If you like it, please share.